What do you mean by financial statements? We can do the analysis later. What do you mean by financial statements in the first place? Financial statements referring to any statement, which involves financial data. The profit and loss account and balance sheet of a company. So generally, financial statements involve, mainly profit and loss account. Then we have balance sheet. Then we also have cash flow statement. These are the three major financial statements. Every company they prepare, whether your company is doing trading or manufacturing or construction or service industry, all business entities have to prepare financial statements. But the term profit and loss account is already outdated. What is the new name we are using? For profit and loss account, we are using Statement of Comprehensive Income. Statement of Comprehensive Income means your P&L account. People used to say P&L account. P&L account means P for profit and L for loss, profit and loss account. Then the word balance sheet is already outdated. What is the new name for balance sheet? The new name for balance sheet is Statement of Financial Position. No more, we are not using the word balance sheet anymore. What is the balance sheet? One of my students told me in a previous class, balance sheet, any sheet which we can balance, any sheet that balances is a balance sheet. But now we are using the phrase statement of financial position. So now in the first place, you must know what do you mean by financial statement. Financial statement means mainly your profit and loss account and balance sheet and cash flow statement. Why should you do the analysis? Why this analysis is required in business? What's the purpose of doing the analysis? Because if you don't do analysis of the financial statement, it's very difficult to make strategic decision making. In business, we have to make a lot of decisions, whether to reduce your selling price or whether to penetrate into a new market, how to reduce control your cost, whether to expand your business, whether company can declare how many month bonus, can we declare dividend to the shareholders, how much is your tax liability, whether company have a financial position, the working capital of the company, is it adequate? So in order to do this, what we need to do, we have to do analysis of financial statements. Financial statement like profit and loss account and balance sheet. How often the company they prepare? They prepare on a monthly basis. Any company, they want to do this analysis, the financial statements to be prepared every month. But from my audit practice, I have seen some small companies where there is no full-time accountant. Sometimes they prepare on a quarterly basis or half yearly, some even annual basis, which is not a good policy. Financial statement must be prepared regularly on a monthly basis. If your company would like to borrow money from any bank, what the bank officer, the credit officer will ask you, hey, can you give me your audited financial statements for the past 2 years or 3 years? Why the banks are asking this? Because the bank would like to, before they can give you the credit, before they can approve any credit limit, the banks would like to do financial statement analysis. What's the purpose of this financial statement analysis? You know, it reveals hidden facts like screening, health screening. When you look at the person, wow, he is very healthy. He looks very handsome. He is very strong. But when you send them for complete health screening, you know, the person have, you know, some health problem. The same way, when you look at the financial statement, it looks very healthy. But when you do the analysis, we can find the hidden factors. I'm showing you an example here. Look at this example. If you want, you can take a screenshot. You can take a screenshot here. Look at this example. The financial statement analysis I'm just giving you because within the limited time frame of 1.5 hours. Usually I conduct this webinar, not now webinar, but as a seminar, as a workshop. In Aventis, we used to conduct this for 1 day. 1 day financial statement analysis, you know, for 7 hours. But now I just give you the key points. What is the key point? All the key points, the summary I'm trying to pass it to you within this 1.5 hours. Financial statement analysis, you look at these, what I'm giving you, this is the extract of summary of profit and loss account. Sales revenue for the first year, just assume it's a new company in existence only for the past 2 years. Sales revenue 1 million, cost of goods sold. So what is cost of goods sold? Cost of goods sold means this is what we call it as, we use this abbreviation in accounting, COGS. Cost of goods sold is called the COGS. How do we calculate? Opening stock plus purchases minus closing stock. What is opening stock? The stock at the beginning, the inventory at the beginning of the year on 1st January is called opening stock. Goods purchased during the year is purchases. The inventory at the end of the year. Unsold goods in your warehouse, in your office, showroom. The closing inventory, yeah, the stock, closing stock. All right? Okay, now gross profit is 500,000. What is the meaning of gross profit? Gross profit is the total profit before deduction, like your gross salary. The gross salary, there is nothing is deducted. Then operating expenses. What's an example of operating expenses? Operating expenses means your rental, salary, CPF, telephone, electricity charges, PUB charges, you know, transportation, all those operating expenses incurred. First year net profit 200,000, second year 300,000. Now I have a question here. Please do analysis of this financial statement. But profit and loss account in real life is not so simple. It runs for maybe 1 or 2 pages. Now I'm giving you the summary here, asking you this question. What is the question? Will you invest in this company? Because the company need new shareholders and investors to continue the journey for year 3. How many of you will invest in this company? Tell me. How many investors in the classroom? We have 52 investors here. We have 52 investors. Will you invest? Will you invest in this company? Your answer is what? Tell me. All the students here, would you like to invest? Yes or no? What do you think? Alex Tan, you don't want to invest. Ki Kundlim also don't want to invest. Anybody want to invest? Just do the financial statement analysis. Would you like to invest? Is there any, at least one single investor here? You would like to get more details, but you have insufficient information to decide. I'm telling you the information, sales revenue 1 million have become double, have become 2 million. Then the cost of sales have increased from 500,000 to 1.2 million. Is more than double. The price have increased. But however, you see the gross profit, even though there is an increase in the cost of sales, the cost of sales is more than double. I agree. But you see the gross profit. Gross profit for the first year is only 500,000. The gross profit have increased to 800,000 in the second year. But operating expenses 300,000 increased to 500. Don't worry, but see the net profit, ultimate net profit. So if any of you, anybody conveys, hey, sales revenue 1 million have increased to 2 million. Gross profit increased from 500 to 800. Net profit have increased from 200 to 300. Come on, invest your money here. The answer is no. Don't invest. Alex Tan, you are right. Ki Kundlim, you are right. Lu Sito, you are right. And Ikra and Tio, you need more information. Huh? The margin line has dropped exactly. You see here, if you want to calculate these, what you must do, you have to do ratio analysis. So financial statement analysis must be done with the help of one of the accounting tools, the tool of management accounting. Accounting ratio is a tool of management accounting. We have different type of accounting. One is called financial accounting, different types of accounting, management accounting, and cost accounting. So what is ratio analysis? Ratio analysis is a tool of management accounting. So ratio analysis, it helps you. Ratio analysis, it helps, for what? To identify the strength and weakness of a company. Ratio analysis, it helps you. Now, if you calculate this ratio, gross profit ratio, net profit ratio, what is this? This is what we call it as profitability ratios. We have different types of ratios. You want to do financial statement analysis, we have to apply various types of ratios that will tell you the hidden problem. What is the strength of a company? What is the weakness of a company? All we can find out. So using this formula, gross profit over sales times 100, net profit over sales times 100, if you calculate, you see the calculation here? The gross profit is not increasing. gross profit margin, gross profit margin decreased to 40%. In terms of dollars, it increased from 500 to 800,000. In terms of dollars, don't compare dollar to dollar. That is not financial statement analysis. We have to compare ratios, accounting ratios. So this is what we do when I do my audit. When my clients send me the trial balance, when the clients send me the trial balance, we normally, what we do? We do the ratio analysis. We do the ratio analysis to identify what is the strength of the company and what is the weakness of the company. And when you calculate the net profit ratio, yes, the net profit ratio also decreased. From 20%, the profit margin decreased. That's why financial statement analysis, the moment you finish, many people never read. In business life, the boss is very busy. All the board of directors, they are very busy in doing business. They are traveling, and somehow COVID-19 situation, how to protect your business. That's our priority. How to save the jobs, how to maintain your customers, how to overcome the crisis. But we have to do financial statement analysis to identify the strength and weakness of a company. Okay, so basically this chapter helps you for what? It highlights the strength and weakness of a company. What is the strength of a company? What is the strength of a company? Oh, my company working capital is adequate. My company financial position is very good. My company inventory is fast moving. My company can keep on, moving very fast. These are the example of a strength of a company. What is the weakness of a company? Can you tell some weaknesses of a company from your knowledge? What is the weakness of your company? Tell me. Any one or two example of a weakness of a company? How do you evaluate the weakness of a company? Example, I give you example. Slow moving inventory is a weakness. Debt collection from customers is very slow, is another weakness. The company have cash flow problem. That is called, we call it as liquidity problem, is a weakness. Then the company is too much debt, depending too much of debt. When the company depends too much of debts, then what happens? The company may collapse anytime. So we have to calculate debt equity ratio. One of the important ratio, we have to do financial statement analysis, debt equity ratio. That's the reason we normally calculate the 4 different type of ratios. So in order to evaluate your profitability, we calculate, cash flow, Alexton, costing, inventory, low receivable. Yes. So by calculating different type of ratios, profitability ratio, we can evaluate whether the company's profitability increasing or decreasing. Liquidity, what is the meaning of the term liquidity? The liquidity means the capacity to pay short-term liabilities of the company. Whether company have liquid funds, whether the company got liquid funds in order to pay the liabilities, to pay the all the short-term liabilities. That is called liquidity ratio. Efficiency ratio, we have got many efficiency ratio, whether this is to evaluate for what? The operational efficiency of a company. Sometimes the company have a lot of mismanagement. I have a client, he is in the gold jewelry industry. This client never do financial statement analysis. All the gold jewelry, they are all outdated, is all in the showroom. The goods is not fast moving, outdated. So a lot of slow moving goods. So that is, your cash flow is locked up there. So you have to free your cash flow. So we have to evaluate, calculate various accounting ratios to evaluate the operational efficiency of your company. Then investment ratio, very important. Investment ratio is what? Every shareholder is interested on ROI. What is ROI? Return on investment. I invest 1 million in a company. What is my profit? That's what we are interested. All the shareholders, investors are interested in the investment ratio, whether the company share value appreciate. So what is the earning per share? Whether the company, how much is the money earned per share for the equity shareholders? All we have to calculate. So financial statement analysis must be made from the viewpoint of the board of directors, from the viewpoint of the shareholders, from the viewpoint of the bankers, from the viewpoint of the tax authorities, Inland Revenue Authority, from the viewpoint of the future shareholder, from the viewpoint of the suppliers who want to give you credit. And if you are a listed company, then even the accounts are published in the public domain. So even the employees, for job security, for stability of their job, they also do financial statement analysis. So students, participants, without any accounting background, because I initially asked you, how many of you are accounts educated? So maybe 13 or 14 students participants have told me. Right now we have 54 participants attending this webinar. So out of 54, 14 participants have some accounting knowledge, meaning the remaining 40 participants have no much accounting background. So for the purpose of helping everyone here, how do you start? How do you, equip your financial statement analysis? That's what, even though it's a free webinar, complimentary webinar, we take our sincerity to give you the full value, as if you have paid for this, as if is a paid webinar. We would like to give professional justice and ethics to give you the full value now. The advantages of these financial statement analysis and disadvantages, I will come back to you later. People who want to do ratio analysis, you have to apply the formula. There are many formula involved with this. You need not copy everything. All the formula is available in all the textbook. Is aging and slow moving stock? Yes. Slow moving stock and aging will affect your liquidity ratio. You are right. Mr. Alex, you are right. You see, when the aging and when the stock is slow moving, what happened? You cannot get the sales revenue. Aging, when your debtors, your customers are delaying the payment, then your cash flow is affected. When the cash flow is affected, your liquidity ratio. We have two types of liquidity ratio later I'm going to show you, which is known as current ratio and quick ratio. These ratios are known as liquidity ratios to evaluate, the liquidity, to evaluate the liquidity position of a company. So as you mentioned, when the aging is delayed, overdue accounts, and the stocks are slow moving, naturally it affects. So we have a lot of formula like this. All these formula, you can get it from the Google. All these formula, you can get it from Google. Like you see, gross profit ratio, net profit ratio. This is what? This is a profitability ratio. Okay, a software development company. What is the, Doris is asking a question here. A software development company, what is the cost of goods sold if there is no stock? Okay, good. The answer is the cost of development of software. For software development company, you engage. We engage the programmers. We engage the programmers with the software engineers, to develop the software. So we pay them salary, we pay them the CPF. So whatever the money that we pay, we incur expenses to develop the software. That is the cost of services. Okay, for any software development company, the COGS. For software development company, we don't call it as a COGS. We call it as cost of services. It is not cost of goods sold, it's the cost of services. Okay, now current ratio, what is the best ratio? The best ratio is number 2. Current ratio and quick ratio, it helps you to calculate the liquidity position of the company. Current ratio is also known as working capital ratio. And quick ratio is also known as acid test ratio. So current ratio, when the current ratio is equal to number 2, the company's financial position is steady. When the quick ratio is equal to number 1, then the financial situation is better. So the same way we have many ratios like stock turnover. Stock turnover means what? It means, movement of inventory. We evaluate whether your inventory is moving fast, by calculating cost of goods sold over average stock. So what is the meaning of average stock? Opening stock plus closing stock divided by 2. But your company is a new company, just started this year. There is no opening stock. Then you change the formula to cost of goods sold over closing stock. Return on capital employed is also known as return on investment. This is an investment ratio, ROI. We calculate ROI. So we have many ratios like this. Debtors collection period. So within how many days we collect money from the customers. So if you want to calculate in terms of number of days, then you change the formula to 365 days. Because here I put 12 months. You want to know Within how many days my customers are paying me? What we do? Change the formula. Debtors. Debtors means what? Credit customers owing my company, owing to my company. So debtors over credit sales times 365. The same way creditors payment period. Then we also calculate whether our fixed asset, what do you mean by fixed asset? All the non-current asset like land and building, plant and machinery, office equipment, motor vehicle, all these fixed assets, are they generating profit? Do they enhance the earning capacity of the company? Whether all the fixed assets are fully utilized is an efficiency ratio, because your assets should not stay idle. Sometimes the building is very big, so some of the place in the building, in the office, is not fully utilized. There is no optimum utilization. So in order to do this, we calculate ratio number 10, fixed asset turnover ratio. What's the purpose of ratio number 13? Ratio number 13, the purpose is cost control and cost reduction. Now, this is very important ratio. When you do the financial statement analysis, almost all companies all over the world, due to COVID-19 situation, there is a pressing need. It's a critical period. Everyone would like to calculate by doing financial statement analysis. We want to calculate the operating ratio because we want to cut cost. The same way, we have lot of ratios to calculate. How many ratios we have? We have more than 40 to 50 ratios. So as you know, it may not be practical, it may not be possible to complete all the 40 to 50 ratios within this short span of 1.5 hours time. Will be quite difficult to do justice to go through all the ratios, but anyway, I'm just showing you one of the another important ratio is what? The gearing ratio. The gearing ratio will tell you the proportion. What is the percentage of money borrowed from other people, long-term debt? Example of long-term debt is what? Term loan and debentures. Term loan and debentures. Debentures is a bond. So how much money we have borrowed from other people and what is our shareholders' investment, shareholders' equity. So all these things we will calculate, So these are the few important ratios I have selected just to highlight. How do we start the calculations? People normally, the beginners, some of you are not accountants. You are not working for any company. If you are not working for in the accounting line, you may be from logistics or engineering or sales or QC, quality control, but you want to learn financial statement analysis in order to better perform, to interact with your finance team, to interact with your customers, in order to submit quotation, in order to prepare the tender. You want to be better educated so that you can avoid accounting errors, accounting flaws. When people talk to you accounting language, hey, debit this account, credit this account. What does it mean? What do you mean by debit this account and credit this account? So in order to understand what is debit and credit, you need to know the basic calculations. For example, you see here for the first question, they give you like this and ask you to calculate the following ratios. Calculate gross profit ratio net profit ratio, cost of goods sold, average stock. So these are the beginning steps. The first three questions, I'm showing you here are just examples. In order to do the financial statement analysis, you must know how to compute these ratios. Okay, you can take a screenshot. Later, during your free time, you can just revise all these things. So when you calculate these, you will get the answers like this. The first two things is what? Gross profit ratio, net profit ratio. So profitability ratios. If the company would like to evaluate profitability, hey, last year, my gross profit margin was 30%. This year, my gross profit margin reduced to 25%. Wow, my profit margin decreasing. Last year, my net profit ratio was, let's say, 15%. Now this year, look at the net profit ratio, reduced to 10%. Was so shocking. That's why we have to do ratio analysis for how many years? You have to do for 3 to 5 years. Last 3 to 5 years, if you do evaluate for current year, you take the current year financial statement, you have to compare with the last 5 years. At least last 3 years. Why last 5 years you do? You know the consistency of your ratio analysis. And when you calculate the cost of goods sold, using the formula opening stock plus purchases minus closing stock, then the average stock, what do you get? You can calculate stock turnover ratio. The stock turnover ratio 5.36 times. What does it mean? Previously, last year, the stock turnover ratio was 9 times. Last year it was 9 times, now 5. That means reduce means what? It indicates slow moving inventory. My goods are not fast moving. Then you have to investigate. Look into it. Why your inventory is slow moving? Is it because of your pricing policy? Is it because of your poor salesmanship? Or is it due to stiff competition in the market? Or maybe is it due to the stage of the product in your PLC, product life cycle? Investigate. For what? In order to take corrective measures. Financial statement analysis, it helps you for making corrective measures. What is this? Return on capital employed. Return on capital employed is what? That is the investment ratio. We calculate our return on investment. Hey, last year, yes, you are right. Lucito, you are right. ROI. Last year, the return on investment was, let's say, 9%. Now suddenly reduced to 5%. Wow, very, very discouraging. As a shareholder, I'm interested in my return on capital employed. Last year was 9%. This year reduced to 5%. Very bad. How can you come to this conclusion? You can derive this conclusion only when you do financial statement analysis. Clear? I'm giving you another example for liquidity position to evaluate the liquidity position of the company. How do you evaluate the liquidity position of the company? We calculate current ratio and quick ratio. Current ratio is also known as what? Working capital ratio. What is working capital? Anybody have any knowledge? What do you mean by the term working capital? Working capital means money used in day-to-day business. But there is a formula for working capital. Working capital is equal to current asset minus current liabilities. What is current asset? Your short-term assets, like cash in hand, cash at bank. See, that's why I mentioned here. What is current asset? What is current liability? So if you look at this example, what is current asset? Okay, so current asset, debtors is a current asset, creditors is a current liability, closing stock is a current asset, cash in hand is a current asset, cash at bank is a current asset, bank overdraft is a current liability. So calculate the current asset and current liability, then calculate the liquidity ratio, current ratio and acid test ratio. So you will get the answers like this. When your answer is equal to 1.71, what is the ideal current ratio? Ideal current ratio should be 2. So when the ratio is 2:1, what does it mean? When the ratio is 2:1, it means, when the ratio is 2:1, it means every $1 liability, current liability, we have $2 assets. Now, we have only 1.71. The company slightly is below number 2. But 1.71 is not so bad. But if your current ratio, let's say, for example, if your current ratio is like this, 0.9, that means very bad. Every $1 liability, you have only 90 cents to pay. The company have liquidity problem. Company having liquidity means what? The ability to pay the liability. This type of company have cash flow problems. Clear? So this is how we calculate the current ratio and quick ratio. Now, all the important ratios when a balance sheet is given like this. You want to take a screenshot, the whole thing, just take a screenshot now. This is a brief summary of a profit and loss account and balance sheet. It's a brief summary of profit and loss account and balance sheet. Just take a photo. Then we want you to calculate all these ratios. These are the preliminary steps. These are the preliminary steps. But anyway, when we do the full day, whole day analysis, we will go much deeper. We will also teach you right from the basic. Prior to this, prior to financial statement analysis, we also have another topic, basic accounting. What do you mean by accounting? What are the different type of accounts? And what is the rule of double entry? Which account to debit, which account to credit? All those things, will be taught more detail in the whole day seminar. So when you calculate this, you will get all these ratios like this. First of all, any financial statement is given, you must calculate all ratios like this. You compare this ratio with the previous year, then the preceding year, then the preceding year. All the last 3 years, 3 to 5 years, you compare. You can make a decision whether company liquidity is improving, whether the company's profitability is increasing or decreasing, whether the company's operational efficiency, is it increasing or decreasing? Or we can, we can find out. We can make a decision. Sometimes we have a company group of companies within the same holding company group. Subsidiary A, subsidiary B, subsidiary C. You can just do intercompany comparison. So these are the ratios we normally calculate. I'm going to shortly show you how do we compare two different companies in the same industry. So two different companies in the same industry, how do we do comparison? I'm going to show you. I'm just running through the slides so that you can just take photo and later on you can evaluate how this can be, all these things can be done. Understand? So this is how you have to apply the formula, take the figures, appropriate value from the financial statements. First, you choose the formula. What is the type of ratio? Is it a profitability ratio or liquidity ratio, efficiency ratio or investment ratio? Classify according to the nature, the type of ratios. Then you just calculate the ratios for 3 to 5 years. Wow, like a scanning report. Everything you can identify. Now you see here, take a screenshot. Take a screenshot of this question number 4, which is the last question. So this is going to be the last question to complete our seminar. Then if you have any questions to ask me later, I will give you time for you to ask me questions to clarify any of your doubts before we can conclude at 12 noon today. Okay? Now, there are two companies given. The first portion is a balance sheet. Superman Company and Spider-Man Company. And we have to calculate Superman and company, Spider-Man Company, we have to calculate what? We have to calculate the following ratios. So when the profit and loss account and balance sheet is given, calculate these ratio, interpret the ratio. What is the problem in ratio analysis? So the problem in ratio analysis means the demerits of these, the shortcomings of these tool of accounting we will discuss shortly. So when you do this, this is the answer for this. Now we are doing what we are doing. Now we do financial statement analysis of two different companies in the same industry. Gross profit for Superman is 30%. Spider-Man only 27%. Who is better? Of course, Superman Company is better. So in terms of profitability, look at the net profit ratio for Superman. Superman net profit ratio is 6.25%. So who is better in terms of profitability? Who is better? Superman and Company is better in terms of profitability. Liquidity. Please remember, current ratio 2:1 is the best ratio. But for current ratio for the first company is 3.5:1. Is it good? No good, because it indicates existence of idle funds. When the current ratio is 2:1 is good. When the current ratio is, say for example, 9:1, that means what? Every $1 liability, current liability, the company have $9 of liquid cash. Why do you keep so much of liquid cash in the bank account in the form of cash? No need. Don't keep your money idle. Therefore, 3.5:1 indicates idle funds. 1.8:1. This is very close to 2:1. Therefore, in terms of liquidity ratio, which company better? Spider-Man. Spider-Man is better. The second one, the first one is a Superman. First one is a Superman, second one, Spider-Man. And coming to return on investment, in terms of investment ratio, who is better? Return on shareholders' interest is what? Is the ROI. ROI for the first one is only 6.94%. And for the second company, 11.98%. So for in terms of investment, Spider-Man is better. Return on investment is better. So in terms of efficiency in debt collection, the first company takes 31 days. Superman takes 31 days to collect money. But Spider-Man is collecting within 8 days. So debt collection is faster. Debt collection is faster in Spider-Man. So what is your overall conclusion now? What is the overall conclusion? The performance of Spider-Man is much better than Superman company. But one recommendation for Superman, Spider-Man is what? Spider-Man have to improve the recommended, it is recommended for Spider-Man. Spider-Man is recommended to improve its profitability. How can I say all these recommendations? Only when I do financial statement analysis, we can do that. Please take a screenshot of these answers. Question 4, take the screenshot of the answer for you to evaluate at your own time. Later, you want to evaluate at your own time to double check the answers. Please go ahead. And the question, if you want to take a screenshot, please take a screenshot. Now, what is the advantage? What is the advantage and disadvantage of financial statement analysis? The advantage and disadvantage of financial statement analysis is this. This financial statement analysis, it helps you. It simplifies the financial statement. How come it simplifies the financial statement? Usually financial statements of a company, the financial booklet, it runs for 25 to 30 pages, even 35, 40 pages. We may not have time to go through all the 30, 40 pages. So ratio analysis, if you calculate within 1 or 2 pages, all the analysis, the summary, the ratio for last 3 to 5 years can be tabulated using the Excel format. It helps for comparing your firm with another firm. It helps you to do the performance evaluation. By looking at the balance sheet, the statement of financial position, we can evaluate, hey, what is my company's current financial position? All the hidden facts. Anything prima facie at the face of it you cannot identify, like going for a health screening, when we calculate accounting ratio, the hidden facts will be highlighted. that facilitates your decision making. The problems in ratio analysis, if you want to see the effectiveness, you need a figure to compare. Gross profit margin is 25%. How do you know it's good or bad? Either you have to compare with the previous year or you have to compare with your competitor. But your competitor information is confidential, not available unless your company is a published, public listed company. The financial statements are in public domain, public website, stock exchange, then you can compare. Comparative information is not available always. Current ratio, what is the best ratio? 2:1. Current ratio, the best ratio is 2:1. Quick ratio, 1:1. So what is the best ratio for stock turnover ratio? What is the ideal ratio? We can't say that because it depends on the industry. Stock turnover ratio or gross profit ratio, it all depends on the nature of business. If you're doing food industry, restaurant, your gross profit margin may be 30 to 40%. You are in electronic industry, let's say for example, you are selling mobile phone, electronic gadgets, then your gross profit margin may be less than 5 to 10%. We cannot standardize. Historical cost. What is the meaning of historical cost? Historical cost means original cost. Land and building. What is the original cost? Original cost, let's say 200,000. How long before? This one 30 years ago. The original cost, if the company follow cost model, we have two models, cost model and fair value model. If the company follow cost model, only the original cost will appear in the balance sheet. What is the market value today? The 2 million, the market value may be, the 200,000, the market value may be 2 million or 4 million. So your company follow cost model, use the historical cost, which is not right. Any problems in financial statements, your accountant is not experienced and anyhow prepare the financial statement, then the financial statement is incorrect. When the financial statement is incorrect, then your ratio is also incorrect. We have to be very careful whether financial statements are prepared in accordance with Singapore financial, Singapore financial reporting standards. So every country have to follow the financial reporting standard, which is an accounting standard guideline. We have to follow accordingly. Window dressing means what? Window dressing means people manipulate the accounts. Manipulation of accounts intentionally, why there is a window dressing, staging to conceal the actual real fact. Window dressing, some country, some people, they do it for many reasons. They don't want to disclose everything. Sometimes they want to borrow money from the bank. They don't want to show everything. They just manipulate. Related party transactions, buying and selling within the group of companies, they don't want to show. Then the director's account, they don't want to reveal. Purposely inflate the profit to borrow money, inflate the assets to borrow money, decrease the profit in order to evade tax, tax evasion, which is an offense. So all these things may take place. Why is not good to keep cash in the bank? So I have a private question here. So students, participants, you want to ask me any question, don't ask me privately, put it in the group chat. So everyone will be benefited. Why is it not good? I have a question here. Students asking me, one of the students, the participants, why is it not good to keep cash in the bank? Because you keep the money in the bank, it is very slow, little margin. If you put it in fixed deposit, the percentage of interest that you earn, is less than 1%. The return on investment is very, 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 very less. But if you do careful planning, you make investment, wise investment, if you do investment appraisal using the techniques, using the payback period, net present value, and so on, evaluate your risk factors, then you can earn better returns. So the answer to the question, why is it not good to keep cash in the bank, is because low return on investment. You keep it in the bank is very, very low returns. You invest somewhere carefully, you get better return on investment. That is the reason. So now the time is 11:45 a.m. now. I have quickly completed the presentation, a short summary of the importance of financial statement analysis. I have gone through with you. Now, if you have any questions, is a Q&A. Students can ask me any questions for the next 15 minutes. Please ask me any questions you want to ask me. Any questions, please ask me. These slides, I'm not sharing the slides, but if you need these slides, I have to check with Aventis what is their policy. We strongly recommend you to register for this seminar. You will learn a lot. Please, using the QR code. What I have given you is just only the glimpse of the one-day seminar, one-day financial statement analysis. Just one-day financial statement analysis I'm showing you here. We'll be discussing more so in the actual seminar for one-day financial statement analysis. Yeah, there is an upcoming seminar on the 27th of July. So there is an upcoming seminar on the 27th of July. So you can register for this seminar to learn more. We'll be teaching more on what is accounting, what are the different types of accounts, what is double entry system, how do you prepare a double entry system, which account to debit, which account to credit, what's the meaning of the term journal entry, what do you mean by ledger, what is trial balance, then how financial decision making, financial statement analysis can be done. All will be discussed in the one-day financial statement analysis. So now I'm answering some of the questions asked by the students. The first question to answer from Theo, are you teaching this course? Yes. On the first day, or on the 27th of July, yes, I'm teaching. The upcoming seminar on 27th of July 2020, morning 9 a.m. to 5 a.m. with one lunch break. Very good lunch. I have been there at level 3. Spice Cafe, Spice Cafeteria restaurant is very good lunch. And yes, I'll be teaching. Consider development cost can be research. So Doris have asked me another question. Development cost can be R&D cost. So how to consider cost of goods sold? Cost of goods sold, we have to, Doris, we have to calculate all the development cost, including the cost of salary, CPF, all the research cost, whatever the cost incurred, we add up everything, that becomes your cost of services. And for Vivian Lee, for going concern any key ratio that gives us the early signals. For early signals, yeah, for going concern, we have to calculate many ratio. Profitability ratio, liquidity ratio, mainly your liquidity ratio. If the liquidity ratio is, let's say 0.5, that means every $1 liability, you have only 50 cents to pay. That itself is a going concern problem. And also your company profitability keep on decreasing. Debt equity ratio, your company is dependent, the leverage, the gearing, over-geared, you borrow too much of money, your liability exceeds, then you have negative equity, return on equity, earning per share. Plenty of ratios can tell you the going concern signal, all the red flags, Vivian. Then, Vivian, I'm answering Dory's question and Vivian question. Then for another one, next one is for going concern. KH, for the paid course, will you be using proper PowerPoint landscape slides? Or same as today, is typing into chat or scrolling through? No, for the actual course, we'll be using worksheet, because a lot of calculations will be done. We'll be also using PowerPoint slides. We'll be also using PowerPoint slides as well. And at the same time, what I have is a booklet. I have a booklet for practice booklet, where questions and so all these things we will work together for the whole day. You see, remember, this chapter is more on calculations. It's not running through the PowerPoint slides. We'll be doing a lot of calculations on the worksheet. Alex Tan, several Japanese, very long, several Japanese giant companies were caught, many still at large. US company, many penny stock listed in many countries. Later, only few were caught by. Why there are such ongoing fraudulent practices everywhere? Illegal. Why they could pass those stringent assessment, but authority always wondering why. Okay, Alexa, fraud can take place everywhere. Fraud and misappropriations and cheating can take place everywhere. That's why regulatory authorities, some countries, they are very stringent, some country moderate, some country, the control measures are not adequate. Even audit, when we do audit of financial statement analysis, we don't give you 100% guarantee. What we do in audit, we also give you true and fair view. Audit also give you true and fair view of financial statements. Opinion. We cannot really give 100% assurance. It all depends. Thank you, Stella. Thank you for saying that the webinar is useful. We will do our best. We will do our best. You have any more questions to ask me? We have another 6 more minutes to ask me. Any further questions? Any further questions? How do you find this seminar? A very brief and complimentary free seminar. Angeline, thank you, Angeline, for your comment. Appreciate it. Ki Kundlim, thank you. Others, can you please let me know your comments? How do you feel? If you're really enrolling for the one-day financial statement analysis, we will discuss more detail. So, Mr. Selvaraj, very useful and impressive. Thank you so much, Lucito. The session was very useful, clear and easy to understand. Thank you, Lucito. Thank you so much, Vivian. Thank you for saying that the seminar is really useful. Alextan, very interesting. I used to hate. Oh, don't hate it. Accounting is a wonderful subject. You can always, accounting is one of the very good profession where you can always demand respect. You can always get employed. You can always make money. The employability is very high. Singapore still is in need of a lot of professional accountants. Angeline, thank you very much, Angeline. Thank you so much. Looking forward to see you all very soon. Ching Duang, thanks for the useful training. Appreciate it. We appreciate.